Hey dudes and duderinas. In today's video, we're diving into the exciting world of Visa stock. Visa is a leading global payments technology company that operates the world's largest retail electronic payments network. They make it possible for you to make seamless and secure transactions, whether you're shopping at your local store or making an online purchase. You've probably used a Visa card or Visa's payment infrastructure without even realizing it. Their innovative solutions make payments fast, secure, and convenient for both businesses and consumers. In today's digital age, Visa is at the forefront of driving the future of payments. They use cutting-edge technologies like contactless payments, mobile wallets, and tokenization to ensure the safety of your financial information while giving you the flexibility to pay the way you prefer. But what about Visa stock? Is it also safe to invest our money in Visa? That's what we'll dive into in today's video. Stay tuned with the Finance Dude. I know you are all excited with this new video, but before we dive in Visa's analysis, don't forget to smash that like button and subscribe to this channel. Now that we have everything ready, let's establish our mission for today. First, we need to assess whether Visa is a good business, and second, assess Visa's valuation. As always, I start this first approach with the 5 dimensions method. And the first dimension to be analyzed is the growth dimension, where I will start with Visa's revenue growth. And what an incredible business we see here, my dudes. Despite being around since 1958 and being already a mature business, Visa continues to impress with its growth. Over the past 10 years, Visa has maintained an annual growth rate of around 10%, totaling an astonishing 163.1% growth. This is remarkable for a company of this size and age. In this metric, I give a solid rating of 4. Now, let's shift our focus to net income growth. Brace yourselves, because Visa's growth rates in this area are even better. Over the last decade, Visa's profits have grown at an annual rate of 12.3%, resulting in a staggering 218.2% growth. This is truly amazing and earns another rating of 4. The same upward trend continues when we examine free cash flow growth. And unlike some other companies I've analyzed like Meta Platforms and Amazon, Visa's profits are well supported by strong cash flows. And let's be honest, cash is what we really want in our company's safe deposit boxes, not just accounting profits in some accountant paper. While net income grew by 218.2% over the past decade, free cash flows saw an impressive growth of 515.1%. That's more than double the net income growth rate, deserving a solid rating of 5. And now, for the cherry on top, let's take a look at the growth in free cash flow per share. Since free cash flows grew by 515.1% over the past 10 years, one might expect that free cash flows per share would have grown at a similar rate, right? Wrong. And you ask, why is that, my dude? And I answer, we'll see why in the 5th dimension, in the shares outstanding metric. Just be patient and stay tuned, my dudes. As for this metric, rating of 5. After the impressive first dimension, let's move on to the second dimension of our analysis, profitability. Starting with gross margin, Visa boasts an impressive current margin of 80%. That's astounding. It means that for every dollar of its services sold, Visa only incurs 20 cents in costs. While Visa has maintained a relatively stable gross margin over the past decade, the current value falls below its 5 and 10-year averages. Considering this, I'll rate this metric with a 2. However, when it comes to net income and free cash flow margins, we have good news. Both margins show a slow but steady increase, indicating that Visa is becoming more efficient year after year. And let me tell you, Visa's margins are mind-blowing. With a free cash flow margin of 56.4%, Visa keeps around 56 cents for every dollar it makes after deducting all costs. It's truly astonishing. I have no words to describe this amazing business. Unquestionably, both receive a perfect rating of 5. The same remarkable trend can be seen in return on invested capital. For every dollar invested in Visa's business, whether through equity or debt, it generates a return of more than 30 cents. That's simply incredible. Another rating of 5 for this metric. Now let's proceed to the 3rd dimension of the analysis, solvency. Starting with the quick ratio, we see that although there has been a slight drop towards the lower end of the 10-year period, the current ratio of 1.5 remains rock solid. I give it a rating of 4. Moving on to debt-to-equity ratio, we can see that Visa had virtually no debt until 2015. However, despite the increased debt levels, debt accounts for only about half of Visa's equity, which is a solid position to be in. Rating of 4 for this metric. Finally, in the debt-to-cash flow ratio, we find that Visa is capable of paying off all its debt using the cash flow it generates in just 1.18 years. Besides its huge growth, its huge profits, Visa is also perfectly solvent. Rating of 5. Now it's time to dig deeper into the key dimension of valuation. We've previously seen incredible businesses with high growth, huge profits, and strong balance sheets, such as Tesla, Microsoft, or Apple, and you can find those analyses on the top right. However, we also observed that their valuations were absurdly high. Now, it's time to assess Visa's valuation and assess whether outstanding businesses always appear to be overvalued. Beginning with the enterprise value to sales ratio, we find that the current ratio is more reasonable compared to the ratios in 2019, 2020, and 2021, although still higher than the first 5 years of the analysis period. In a typical situation, an EV to sales ratio of 16.64x could be considered high. However, considering Visa's impressive profit margins, these multiples can be justified. After all, it's rare to find a business with a free cash flow margin exceeding 50%, not even Microsoft nor Apple. Taking all factors into account, I assign a reasonable rating of 3 to this metric. In price to free cash flow and price to earnings multiples, we can see that both are trading at the lower end of their range, which is astonishing. Price to free cash flow multiple receives a rating of 5 and PE ratio receives a rating of 4. Lastly, let's move on into the fifth dimension of our analysis, dividends. Visa has been consistently paying dividends since 2008, and the yearly growth rate over the last decade is a mind-boggling 17.5%. 10 years ago, Visa was paying a dividend of 33 cents per share. Now it is paying $1.65, marking a fourfold increase in just a decade. This earns a well-deserved rating of 5. What an exceptional business. While a dividend yield of 0.69% may not be considered attractive, it is worth noting that it beats the 5 and 10-year averages. Moreover, let's not forget the significant dividend growth rates. If you had purchased Visa stock in 2013, you would now be enjoying a yield on cost of 2.96%, almost 3%. Not too shabby, right? Taking all this into consideration, I rate this metric with a 4. Moving on to the shares outstanding metric, the numbers are truly staggering. Visa has bought back over 500 million shares in the last 10 years, which accounts for almost 1/5 of its outstanding shares a decade ago. This is simply amazing. And as promised, let's discuss the difference in growth between free cash flows and free cash flows per share. To make it simpler, let's imagine the fictional ABC Corp with 100 outstanding shares in 2013 and free cash flows of $500. This would result in a free cash flow per share of $5. Now, let's suppose that by 2023, the ABC Corp increases its free cash flows to $5,000 but doesn't buy back any shares, maintaining the 100 outstanding shares. The free cash flow per share is now $50, and the total growth for both free cash flows and free cash flows per share is 10 times, or 1,000%. However, if the ABC Corp had bought back 20% of its 2013 outstanding shares, resulting now in 2023, 80 outstanding shares, with the same free cash flows of $5,000, the free cash flow per share would be $62.50, not the $50. While the total free cash flow growth remains 1,000%, in this case, the free cash flow per share growth is 1,150%, not 1,000%. Shareholders witness a higher increase in per share profits compared to the overall increase in company profits. This metric cannot be emphasized enough. Given the incredible rate of stock buybacks by Visa, I rate this metric with a perfect score of 5. Lastly, we see in dividend payout ratio metric that Visa only pays in dividends about 20% of the cash flows it generates each year, which gives plenty of room for insane dividend growth rates like we've seen over the past decade. Once again, a rating of 5. Now, it's time for the summary table with every 5D component. After carefully examining each component of the 5 dimensions, we arrive at an outstanding final rating of 4.25 out of 5. Wow, what a business. Looking at this 5 dimensions, we see that Visa doesn't have any apparent weaknesses. The dimension that lags the others is the valuation dimension, but a rating of 3.5 is more than positive. But to tackle Visa's valuation, we'll dive deeper in DCF and multiple valuations to confirm whether Visa is fairly valued. But before we get to the juicy part, I need a favor from you. If you're having fun watching this video and learning something new, please show some love and support to the dude by doing these 4 simple things. Subscribe to the channel, smash that like button, ring that bell, and spread the word to your peeps. Okay dudes, we're ready to rock and roll with this DCF valuation. Upon analyzing the historical averages of our model variables, we observe that the only slightly less positive aspect is the deceleration in the rate of shares buyback. While the 5-year average was 2%, the current rate stands at 1.2%, which is still more than great. However, in other variables, we witness remarkable results. Over the last 12 months, revenues have grown by 28.5% compared to the full year revenues of 2021, surpassing the 5 and 10-year averages. Similarly, cash flows have experienced a growth of 25.1% in the last 12 months compared to the 2021 full year cash flows, again exceeding the 5 and 10-year averages. Furthermore, the current free cash flow margin surpasses its 5 and 10-year averages, and the current price to free cash flow multiple is lower than its 5 and 10-year averages. Visa's business is definitely going full steam. In terms of analysts' expectations, they anticipate a 9.16% annual growth rate in revenues over the next 3 years, surpassing the growth rate witnessed in the past 5 years. Based on these assumptions, we can expect revenues to reach around $40 billion in 2025. As for earnings per share, they project a yearly growth rate of 14.68%. As you already know, since I do not have any free cash flow projections, I use EPS as a proxy for free cash flow growth. Under these assumptions, we anticipate free cash flows to amount to $23.8 billion in 2025, resulting in a free cash flow margin of 59.1%, which is higher than the current margin of 56.4%. As we can see, the future also looks promising for Visa's business. But enough talk, my friends. I know you're eager to hear my assumptions and the results. My base case scenario goes in line with Wall Street analysts. Visa will maintain its market leader position and wide moat. It will continue its remarkable growth, mainly in emerging markets with the shift from cash towards electronic payments. With this, Visa will be able to maintain its impressive margins, rewarding stockholders through shares buybacks and dividend payments. Cash flows are projected to grow at an annual rate of 11% over the next 10 years, reaching $49.5 billion, while revenues are expected to grow at a rate of 10.5% to $83.8 billion. Under these assumptions, investors could pay up to $359.54 for the stock to enjoy a 12% yearly return. Or conversely, buying the stock at the current price would make us enjoy an outstanding 16.4% yearly rate over the next 10 years. In addition, Visa's market capitalization is projected to grow from $500 billion to $1.3 trillion in 10 years. This scenario suggests that besides Visa being an exciting business, it is also a potentially undervalued company. Now, let's shift gears to the bull case scenario. In this scenario, I consider that Visa gains market share and benefits from a faster shift towards electronic payments. This strong market position enables Visa to benefit from the network effect and enjoy substantial cost advantages, ensuring long-term sustainability, growth, and higher margins. In this bull case scenario, annual cash flow growth is projected at 13% over the next 10 years, reaching $59 billion, while revenue growth is anticipated to be 11.9% annually, resulting in $95.4 billion in revenues 10 years from now. Buying the stock at the current price could yield a remarkable 20% yearly return over the next decade. To achieve our required rate of return of 12%, we could potentially pay nearly double the current price, highlighting a severe undervaluation of Visa stock. In bear case, I anticipate a moderate financial crisis at some point of the next decade. Visa's revenue is highly dependent on consumer transactions, making it sensitive to economic downturns. Under this scenario, cash flows are projected to grow at a rate of 7% per year, reaching $34 billion in 10 years, while revenues are expected to reach $61 billion, representing a modest doubling over the decade. Although this growth may seem optimistic, let's not forget that Visa's revenues almost tripled over the last decade. However, even in this grim scenario, we could pay up to $231.39, which is approximately the current price, to enjoy our required rate of return of 12%. This is truly astonishing. Even in the bear case, Visa's stock appears to be fairly priced. Wow, am I missing something, my dudes? Is this too good to be true? Let me know down in the comments. Now, let's move on to the extreme cases. In the extreme bull case scenario, cash flows are projected to grow at a rate of 15.9% annually to $76.7 billion, more than 3 times the current cash flows and revenues growing at a rate of 14.3% to $118 billion. Visa's market cap would grow to $2.5 trillion and be the undefeated king in payments processing. Investing in the stock at the current price would provide us a 24.7% annual return over the next decade, with stock prices reaching more than $1,500, which is insane. Finally, in the extreme bear case scenario, I anticipate a significant financial crisis during the next decade. Additionally, Visa faces legal and regulatory risks, as evidenced by fines imposed on Visa and other payment networks in the past. Lastly, it lags behind new competitors in the payment industry that emerged from the wide adoption of cryptocurrencies and blockchain technology. In this unlikely situation, Visa would provide investors with a negative 6.8% annual return over the next decade, with the stock price and market cap tanking to $75 and $159.7 billion, respectively. Now, keep in mind that these assumptions are just a first gauge of Visa's valuation and don't incorporate qualitative information from more advanced analyses such as Analysis 2.0. Before making any investment decision, I would need to stress these assumptions. But for now, I hope this gives you a good idea of where Visa stands in terms of valuation. This is the summary table with all the scenarios' price targets and probabilities. The probabilities that I think best reflect the scenarios I made are 60% for base case, 23% for bull case, 15% for bear case, 1% for extreme bull case, and 1% for extreme bear case. Based on the probabilities and assumptions considered, the final price target for the stock to achieve a 12% yearly return is $366.19. This suggests that the stock is currently undervalued by approximately 53.9% compared to its current trading price. The graph presented indicates that Visa is trading in a range between undervaluation and fairly valued territory, which is quite remarkable. Is it possible that this insane business is actually undervalued? This is exciting, but be reminded that an investment decision will only be made after a more in-depth analysis 2.0. But for now, let's finish this analysis 1.0 with the multiple valuation. And this method suggests that Visa is trading at a fair value. The current price of the stock is $237.97, and historical multiples indicate a fair value of $237.69. And now it's time to wrap up the first analysis of Visa's business by comparing the three different data points: 5 dimensions, DCF valuation, and multiple valuation. One of our missions for today was to assess whether Visa is a good business and ready for Analysis 2.0. Using the 5 dimensions method, we assessed Visa's overall performance, resulting in an outstanding final rating of 4.25. Notably, Visa excels in every dimension, indicating a very complete business. The dimension with the worst rating was the valuation dimension with a rating of 3.5, which is still very positive. Indeed, in our second mission of evaluating Visa's fair price, we found that it is extremely undervalued in DCF valuation and fairly valued in multiple valuation. Both methods suggest that Visa is at least fairly valued, which is great news for us hidden gem seekers. Taking these findings into account, it's time for my final verdict. Visa will undoubtedly proceed to the next round, Analysis 2.0. Visa demonstrated to be one of the best businesses I've analyzed on this channel, and unlike other outstanding businesses like Apple and Microsoft, Visa appears to be at least fairly valued, which is extremely rare for this type of companies. However, there's still more to uncover in Analysis 2.0. In Analysis 2.0, I'll dive deeper into Visa's financial statements. I'll analyze its different revenue segments, identify the key growth segments, compare Visa to its competitors, assess the main risks, examine management's stock activity, review the latest earnings call, and study the last 10K and 10Q reports. All this information will help me improve the assumptions of my DCF valuation model and make it more accurate. If you can't wait for this improved analysis of Visa stock, please consider subscribe to the channel, turn the bell on, hit the like button, and share with your friends and family. Your support will help the channel grow and reach more people who can benefit from this type of analysis. Together, we can make a difference. Peace, dudes. You rock.